Every time you swipe your credit card, someone makes money. It triggers a mechanical transfer of wealth into the banking system. These institutions operate on a model designed to engineer perpetual borrowing rather than building consumer net worth. Credit cards minimize the immediate psychological impact of a purchase, allowing you to acquire goods without the visceral sensation of loss. Banks leverage this lack of friction by rebranding high-interest debt through metal cards and complex reward structures. They market an image of exclusive access, the quiet comfort of a private lounge, and the perceived status of a luxury traveler. Behind these perks, the industry operates on a specific discovery. A customer's financial health is often a ceiling on bank revenue. A person permanently carrying a balance generates significantly more profit than someone who pays their bill in full every month. Modern transactions are designed to be frictionless, removing the physical obstacles between a desire and a purchase. Spending physical cash creates a tangible sense of diminishing resources. Your brain registers the literal weight of the money leaving your hands. Because no physical asset is surrendered during a swipe, the mind categorizes the resulting debt as invisible money. This psychological bypass is reinforced by a social media culture that demands the immediate projection of wealth. Credit cards allow a shopper to leave this boutique with designer labels, using capital they haven't earned yet. The elevated status provided by the purchase lasts until the statement arrives at the end of the month. Millions of people are currently financing a standard of living that their actual income cannot sustain. To maintain this cycle, banks emphasize the minimum payment option, which is the most profitable path for the lender. This line represents a $5,000 balance. If you only pay the minimum, the principal barely moves. Meanwhile, compounding interest grows in the background. Over several years, the total amount paid can easily exceed double the original price of the item. Banks use behavioral data to identify which users are most likely to spend impulsively or miss a payment deadline. The system advertises 2% cashback, while simultaneously charging interest rates that frequently exceed 25%. These reward systems function as a psychological incentive to increase the total volume of consumer spending. The industry derives its primary wealth from interest and penalties, harvested from users who are unable to clear their debt. The scale of these institutions reflects the massive volume of individual consumer debt they manage, and the aggregate of these millions of individual loans has become the primary engine of our modern market growth. Borrowing is now a normalized component of daily life, used to manage stress or meet basic societal expectations. While the average citizen works longer hours to service their balances, the banking system collects passive interest in the background. Credit cards are precision tools designed by experts to capture the value generated by human impulsiveness. The wealthiest individuals utilize debt as a calculated leverage tool, while the system profits from those who use it for consumption. Remember, every swipe is a choice. You are either buying your freedom or financing your future stress.